David M. Rubenstein's book, How to Invest, covers a wide range of investment strategies and insights. Here are 10 main points from the book. 1. Always invest with a long-term perspective in mind, as this will help you ride out short-term fluctuations in the market. 2. Be sure to diversify your investments across different asset classes, industries, and geographies to manage risk and optimize returns. 3. Consider investing in alternative assets such as real estate, private equity, and infrastructure, which can offer high returns, but also come with higher risk. 4. Look for investment opportunities in emerging markets, which can offer higher growth potential, but also come with greater political and economic risk. 5. Be mindful of the fees and costs associated with investing, as these can eat into your returns over time. 6. Consider investing in index funds or other passive strategies, which can offer low fees and broad exposure to the market. 7. When evaluating stocks, focus on the quality of the company's management team, its financials, and its competitive positioning within the industry. 8. Consider investing in companies that have a sustainable competitive advantage or moat, such as a strong brand or proprietary technology. 9. Be wary of hot investment trends or fads, as these can be short-lived and lead to unsustainable valuations. 10. Stay informed about macroeconomic and geopolitical trends that can impact the markets, but don't try to time the market or make sudden changes to your investment strategy based on short-term fluctuations. The first main point from David M. Rubenstein's book, How to Invest, is to always invest with a long-term perspective in mind. This means that when investing in stocks, bonds, or other assets, investors should focus on their future prospects over the long run, rather than trying to make quick gains by timing the market or reacting to short-term fluctuations. Investing with a long-term perspective can help investors avoid the temptation to buy and sell assets based on short-term market trends or news. Instead, it encourages them to focus on the underlying fundamentals of the investments they hold, such as a company's financial health, competitive positioning, and growth potential. Moreover, investing with a long-term perspective also helps investors ride out market volatility and economic downturns. While short-term market fluctuations can be unsettling, over the long run, markets have historically tended to rise. By staying invested over a long period of time, investors are more likely to capture the benefits of this long-term trend and achieve their financial goals. Finally, investing with a long-term perspective can help investors avoid the negative impact of transaction costs and taxes that can result from frequent buying and selling. By holding investments for the long term, investors can benefit from lower transaction costs, as well as the potential tax benefits of long-term capital gains. The second main point from David M. Rubenstein's book, How to Invest, is to diversify your investments across different asset classes, industries, and geographies to manage risk and optimize returns. Diversification is an essential investment strategy that aims to reduce risk by spreading investments across different assets. This means investing in a mix of stocks, bonds, real estate, commodities, and other assets, with exposure to different industries and geographies. Diversification can help investors avoid the risks associated with investing in a single asset or industry. By investing in a diverse range of assets, investors can reduce their exposure to any one asset class or industry, which can help to manage risk and reduce the impact of market fluctuations. Moreover, diversification can also help to optimize returns by taking advantage of different investment opportunities. By investing in a diverse range of assets, investors can access a broad range of investment opportunities and capture the benefits of different investment strategies. When diversifying investments, it's important to balance the risks and rewards of different asset classes and industries. While investing in high-risk assets, such as emerging markets and alternative assets, can offer higher returns, they also come with higher risk. Conversely, investing in more stable and predictable assets, such as blue-chip stocks and government bonds, can offer lower returns, but also lower risk. Overall, diversification is an essential investment strategy that can help investors manage risk and optimize returns over the long term. The third main point from David M. Rubenstein's book, How to Invest, is to consider investing in alternative assets such as real estate, private equity, and infrastructure, which can offer high returns, but also come with higher risk. Alternative assets are investments that fall outside of traditional asset classes such as stocks, bonds, and cash. These can include real estate, private equity, hedge funds, commodities, and infrastructure, among others. While alternative assets can offer higher returns than traditional assets, they also come with higher risk due to their complex nature, limited liquidity, and lack of transparency. Investing in alternative assets requires more specialized knowledge and expertise than investing in traditional assets. Investors need to understand the unique risks and characteristics of each alternative asset class, as well as the market dynamics that can impact their performance. Real estate is a popular alternative asset class that can offer attractive returns through rental income, capital appreciation, and tax benefits. Private equity investments can offer high returns by investing in private companies that are not publicly traded, but they also come with high fees and limited liquidity. Infrastructure investments can offer stable returns by investing in essential assets such as airports, highways, and power plants, but they can also be subject to regulatory and political risks. Investing in alternative assets can be a valuable addition to a well-diversified portfolio, but it should be done with caution and only after careful consideration of the risks involved. Alternative assets should also be a smaller proportion of an investor's overall portfolio to manage the higher risk associated with them. The fourth main point from David M. Rubenstein's book, How to Invest, is to invest in companies with strong competitive advantages, or moats, that can help them sustain their profitability and growth over the long term. A moat refers to a company's ability to maintain a competitive advantage that sets it apart from its competitors. This can be achieved through factors such as strong brand recognition, high switching costs for customers, proprietary technology, or economies of scale. Companies with strong moats are better able to sustain their profitability and growth over the long term, as they are better able to defend against competitive threats and maintain their market position. This can result in higher earnings growth, greater cash flow, and higher returns on invested capital. When evaluating companies, investors should look for factors that contribute to a company's competitive advantage, such as a strong brand, patent-protected technology, or a dominant market position. They should also consider the company's financial health and management team, as well as the industry dynamics that can impact its growth prospects. Investing in companies with strong moats can be a valuable long-term strategy for investors looking to generate sustainable returns. By focusing on companies with competitive advantages, investors can identify companies that are better positioned to weather market downturns and generate consistent returns over the long term. The fifth main point from David M. Rubenstein's book, How to Invest, is to invest in index funds as a low-cost, diversified way to gain exposure to a broad range of stocks. An index fund is a type of mutual fund or exchange-traded fund, ETF, that tracks a specific stock market index, such as the S&P 500 or the Nasdaq. By investing in an index fund, investors can gain exposure to a broad range of stocks, while also diversifying their portfolio across different industries and sectors. Index funds have become increasingly popular in recent years due to their low fees and ability to provide broad market exposure. Because index funds are passively managed, they typically have lower fees than actively managed funds, which can eat into investment returns over time. Moreover, investing in index funds can also help investors avoid the risks associated with picking individual stocks or trying to time the market. By investing in a broad-based index fund, investors can capture the returns of the overall market, rather than trying to predict which individual stocks will outperform or underperform. Investing in index funds can be a valuable way for investors to gain exposure to the stock market in a low-cost, diversified manner. By investing in a mix of index funds that track different market indexes, investors can further diversify their portfolio and reduce their exposure to individual stocks or sectors. The sixth main point from David M. Rubenstein's book, How to Invest, is to consider investing in emerging markets, which can offer higher growth potential but also come with higher risk. Emerging markets are countries that are in the process of developing their economies and financial markets. These can include countries in Asia, Africa, Latin America, and the Middle East. While emerging markets can offer higher growth potential than developed markets, they also come with higher risk due to their political and economic instability, currency fluctuations, and other factors. Investing in emerging markets requires more specialized knowledge and expertise than investing in developed markets. Investors need to understand the unique risks and characteristics of each emerging market, as well as the market dynamics that can impact their performance. Investing in emerging markets can offer higher returns due to their faster economic growth and higher earnings growth potential. However, this potential for higher returns also comes with higher volatility and risk. Investors interested in investing in emerging markets should consider investing in mutual funds or exchange-traded funds, ETFs, that focus on emerging market stocks or bonds. These funds can provide diversified exposure to emerging market economies and help investors manage the risks associated with individual countries or sectors. Investing in emerging markets can be a valuable addition to a well-diversified portfolio, but it should be done with caution and only after careful consideration of the risks involved. Emerging market investments should also be a smaller proportion of an investor's overall portfolio to manage the higher risk associated with them. The seventh main point from David M. Rubenstein's book, How to Invest, is to consider investing in alternative investments, such as real estate, private equity, or hedge funds, as a way to diversify a portfolio and potentially generate higher returns. Alternative investments are investments that do not fit into traditional asset classes such as stocks, bonds, or cash. These can include real estate, private equity, hedge funds, commodities, and other assets. Alternative investments can offer higher returns than traditional investments, but they also come with higher risk and less liquidity. Private equity and hedge funds, for example, often require high minimum investments and have lock-up periods where investors cannot withdraw their money. Real estate, on the other hand, can offer diversification benefits and the potential for steady cash flow through rental income. Real estate investments can include direct ownership of property or investment in real estate investment trusts, REITs, which provide exposure to a broad range of real estate assets. Investing in alternative investments can be a valuable way to diversify a portfolio and potentially generate higher returns. However, these investments should only be made after careful consideration of the risks involved, and investors should have a clear understanding of the fees and other expenses associated with these investments. Investing in alternative investments can be more complex than investing in traditional investments, and it may require specialized knowledge and expertise. Therefore, investors should consider consulting with a financial advisor or professional before investing in alternative investments. The eighth main point from David M. Rubenstein's book, How to Invest, is to invest in companies with a strong competitive advantage or economic moat. An economic moat refers to a company's ability to maintain a competitive advantage over its peers and sustain its profits over time. Companies with a strong economic moat can withstand competition and market fluctuations, and are more likely to generate consistent returns for investors. Companies with a strong economic moat can have various advantages such as a dominant market position, brand recognition, proprietary technology or patents, high switching costs for customers, and other factors that make it difficult for competitors to enter the market. Investors can identify companies with a strong economic moat by analyzing their financial statements, industry dynamics, and other factors that contribute to their competitive advantage. For example, investors can look for companies with high profit margins, strong customer loyalty, and consistent earnings growth over time. Investing in companies with a strong economic moat can be a valuable way to generate long-term returns, as these companies are more likely to withstand market fluctuations and continue to generate profits over time. However, investors should also be mindful of the risks associated with investing in individual stocks and should diversify their portfolios across different sectors and asset classes. The ninth main point from David M. Rubenstein's book, How to Invest, is to consider investing in index funds or exchange-traded funds, ETFs, as a simple and low-cost way to gain exposure to a broad range of stocks or bonds. An index fund is a type of mutual fund, or ETF, that tracks the performance of a specific stock or bond index, such as the S&P 500 or the Russell 2000. Index funds and ETFs provide investors with diversified exposure to a broad range of stocks or bonds, making them a simple and low-cost way to invest in the stock market. Index funds and ETFs can provide investors with a range of benefits, including low fees, high liquidity, and broad market exposure. Because they track the performance of a specific index, they offer investors exposure to a broad range of stocks or bonds, reducing the risks associated with individual stock picking. Investing in index funds or ETFs can be a valuable addition to a well-diversified portfolio, especially for investors who are looking for a simple and low-cost way to invest in the stock market. However, investors should still be mindful of the risks associated with investing in the stock market, such as market volatility and the potential for losses. Investors should also carefully evaluate the fees and expenses associated with index funds and ETFs, as well as their performance and historical returns, before making investment decisions. It is also important to note that index funds and ETFs are not without risk, and investors should still consider diversifying their portfolios across different sectors and asset classes to manage risk. The 10th main point from David M. Rubenstein's book, How to Invest, is to stay disciplined and avoid emotional investing decisions. Investors can experience a range of emotions when investing, including fear, greed, and regret, which can lead to impulsive and irrational investing decisions. Emotional investing decisions can result in buying high and selling low, or chasing after fads and trends that can be detrimental to a well-diversified investment portfolio. To avoid emotional investing decisions, investors should stay disciplined and develop a long-term investment plan based on their financial goals, risk tolerance, and time horizon. This plan should be reviewed periodically and adjusted as needed to ensure that it remains aligned with their goals and circumstances. Staying disciplined also involves avoiding the temptation to make sudden and impulsive investing decisions based on market fluctuations or short-term trends. Instead, investors should focus on the long-term outlook and avoid getting caught up in short-term market volatility. In addition to staying disciplined, investors should also seek out professional advice and guidance from financial advisors or other investment professionals. These professionals can provide valuable insights and expertise to help investors make informed and objective investing decisions. By staying disciplined and avoiding emotional investing decisions, investors can increase their chances of achieving their long-term investment goals and building a well-diversified investment portfolio that can weather market fluctuations and deliver consistent returns over time.
Thank you for your interest in this book. I would much appreciate if you leave your feedback on this book in the comments below or just put a like on this video. You can find links in the description of this video, where you can purchase and download this book.